Welcome to the Markets Playbook. Most channels give you the theory. We use data to show you the high probability moves. Now, I won't always be right, but I will always try to give you something actionable by showing you the reasoning behind market moves so you can decide for yourself and position for what's next. Man, the headlines are pretty scary right now. There's no doubt about it. Geopolitical tensions are running hot, and we've seen a really sharp sell-off across the board. It just feels like a time to be cautious, right? But here's the thing. If you look past all the noise and into the market's internal plumbing, the data is telling a completely different story, one that suggests this fear has created the perfect setup for a powerful rebound.
All right, so here's how we're going to break it down. We'll start with why the market was already prepared for a fall. Then we'll look at what history tells us about these kinds of shocks. After that, we'll uncover the mechanical forces building under the surface. Then we'll ask if the market's biggest players are about to wake up. And finally, we'll put it all together into an actionable game plan.
Okay, let's dive right into this first idea because it's crucial: the over-hedged market. The big idea here is that the sell-off we just saw, it isn't the start of a crash. It might actually be the trigger for a bounce. And it all comes down to what the big institutions were doing before all the scary headlines hit. So, have you ever wondered this? You see this terrifying drop one day, and then an explosive rally the next, and it just feels totally random, but it's not. There's a powerful, almost mechanical reason for it, and it all starts with how the smart money prepares for risk. And this right here is probably the single most important number for our whole case. Before this recent sell-off even happened, the SPX Skew, which is basically a measure of fear, was in the 96th percentile. Just think about that. The big money was more insured against a crash than it had been 96% of the time over the past year. They weren't caught off guard by this. They were ready for it. So what is this SPX Skew thing? Well, in really simple terms, it's the price of insurance. When big funds get worried, they buy put options to protect their portfolios if the market drops. And when demand for those puts gets crazy high like it was, the price of that insurance just skyrockets. This tells us the market was already bracing for impact. Okay, so here's the wild part. Here's how all that insurance actually causes the bounce. When the market drops like it did, those protective puts become super profitable. But there's a catch. Options expire. Time is not on their side. Every single day, the value of those puts decays away. So investors are literally forced to sell them quickly to lock in their profits. And when they sell, the market makers on the other side of that trade have to buy back stocks to flatten out their positions. This creates a huge, automatic wave of forced buying that can fuel an absolutely explosive rally.
So the mechanics are definitely pointing to a bounce, but is this just a fluke? Let's see what history has to say. The takeaway so far is that the market was already insured, which sets the stage for a mechanical bounce. So the big question now is, have we seen this movie before?
Well, the data is crystal clear. Markets are just incredibly resilient to these kinds of shocks. I mean, look at the Gulf War, 9/11, the invasion of Ukraine. In every single case, there was a sharp, painful drop, but it was followed by a pretty quick recovery. The initial fear gives way to the reality that these tragic events, well, they rarely derail long-term economic trends. History just screams that panic selling during these events is almost always the wrong move.
And you know, this quote from Joe Wiggins just hits the nail on the head. Our natural instinct during times of stress is to run for the hills, right? But that emotional reaction is exactly what causes people to sell at the bottom and then completely miss the powerful rebound that history shows is so likely.
All right, so history's on our side. Now let's connect that to what's happening right now. Let's look at the current data that shows the engine for a rally is already revving up. And these aren't opinions. These are just the market's mechanical tripwires waiting to be sprung. First up, the VIX, the fear index, it spiked to a level of extreme panic. That fear got so intense that traders were paying more for protection today than for protection in the future. That's a condition called backwardation. And that right there is a textbook sign that the panic has gone way too far. And here's the trigger. When that fear inevitably cools down, these giant automated funds are forced by their own rules to buy stocks. It's not a choice, it's just code. And check this out. 2 more data points complete this explosive picture. First, ETF trading volume hit a 5-year high. That tells us investors were hedging with short-term tools, not dumping their long-term core stocks. Second, and this is so critical, the market is incredibly thin right now. Liquidity is in the 4th percentile. It's like a hallway with no furniture. A small sound can echo like crazy. So that forced automatic buying we just talked about, it's going to hit a market with very few sellers, which could cause prices to just scream higher.
So the market's plumbing is primed. Extreme fear and thin markets mean a little bit of buying can go a really long way. Now for the final piece of the puzzle. There's this strange anomaly that's been holding the market back, and it involves its biggest, most important sector. First, just a quick reminder of how dominant the tech sector is. It's nearly a third of the entire S&P 500. The math is pretty simple, right? The index cannot have a meaningful, sustainable rally if its biggest player isn't on the field. What tech does, the market does. And this is wild. We haven't seen something like this in 30 years. 2/3 of all stocks are actually beating the index itself. Just think about that for a second. It tells you the troops, the broader market of smaller companies, are actually strong and advancing. But the generals, the mega cap tech stocks, are lagging behind and holding the whole average back. This is a very rare and frankly unsustainable situation. So what could get the generals back in the fight? Well, look no further than NVIDIA's upcoming GTC conference. This isn't just another product launch. This is where the entire narrative for AI could get reset. With huge announcements expected around their next-gen platforms, GTC is basically the perfect catalyst to reignite those animal spirits and bring a wave of money roaring back into the lagging tech sector. Okay, let's tie this all together. The market's leaders have been sleeping, but a major catalyst is just around the corner. We have an over-hedged market, history on our side, a mechanical buying engine ready to go, and a trigger for the market's most important sector. So what does this all mean for positioning? And let's add one final powerful tailwind: seasonality. Looking at data all the way back to 1928, March is usually a pretty quiet month, but April is historically the second best performing month of the entire year. So as we flip the calendar, we're stepping into a period with a strong historical wind at our backs. And look, this is so important to understand. This thesis isn't about trying to predict the outcome of a war or some global political drama. That's a fool's errand. This is a bet on market mechanics. It's a bet that when all this extreme fear dies down, money will flow back to where it always does, to the highest quality companies with the strongest fundamentals. This quote right here just says it all, doesn't it? The math of the market dictates that the index needs its leaders, and the fundamentals dictate that the most profitable companies on the planet can't be ignored by investors for very long. That tension, that's what has created this coiled spring. So I'll leave you with this question. The headlines are going to continue to be scary and uncertain. That's a given. But the market's internal mechanics are pointing forcefully in the other direction. The spring is wound tight, so you have to ask yourself, are you positioned for the headlines, or are you positioned for the inevitable release?